Coming up on Market to Market, hundreds sound off on the proposed changes to the Renewable Fuel Standard. And while some portions of farm country are knee-deep in water, one remains locked in drought, prompting a rural-urban debate. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by Renewable Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Renewable Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, July 26th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Public and private reports were mixed this week on the U.S. economy. According to the National Association of Realtors, sales of existing homes climbed more than 5% in May. Purchases of new homes rose 2.2% last month to levels not seen since February of 2008. But the Commerce Department reports that orders for long-lasting durable goods hit some turbulence in April, falling by 1.8% due to weaker demand for aircraft. Stripping out the volatile transportation sector, however, orders actually rose 0.5%. And July corn futures posted their largest weekly gain in more than 2 years as persistent heavy rains dampened prospects for bin-busting production. Corn-based ethanol, of course, is at the center of a national debate over how much of the renewable fuel should be required at the pump. And late this week, government officials ventured into the Corn Belt to hear comments about their plan to reduce the amount of ethanol in America's gas tanks. More than 300 farmers, ethanol refiners, politicians, and an alphabet soup of ethanol advocacy groups assembled this week in Kansas City, Kansas, to tell EPA officials exactly what they think of the proposed changes to the Renewable Fuel Standard.
You are allowing the petroleum industry to continue its stranglehold on the fuel system in our country.
Chris Grundler, director of the Office of Transportation and Air Quality, is in charge of handling proposed changes to the RFS.
More specifically, due to the fact that cellulosic biofuel has not come online as fast as we all hoped, coupled with the current constraints in the fuel market to accommodate increasing volumes of ethanol, the volume targets specified by Congress in the Clean Air Act for 14, 15, and 16 cannot be achieved.
But more than one attendee brought up the fact that EPA can only make rule changes if there is an inadequate supply or if increased biofuel use will cause economic harm.
We continue to believe that EPA is overstepping the bounds of its legal authority by proposing to partially waive the RFS based on perceived distribution capacity constraints. In fact, Congress did consider measures that would have allowed waivers based on distribution infrastructure, but they rightly rejected those concepts because they knew allowing that type of off-ramp would entice the oil companies to hold the RFS program hostage, as they are now doing.
The Renewable Fuel Standard was designed to help increase energy security, reduce pollution, and promote growth of the ethanol industry. There were always plans to increase E10, a mix of 10% ethanol and 90% gasoline, to higher blends, including E15. Petroleum interests have been hesitating to increase the mix, saying there is a blend wall and no more of the predominantly corn-based additive can be added to the fuel supply. However, ethanol supporters take exception to this claim.
Left to their own devices, oil companies won't reduce the carbon intensity of gasoline. They've earned the label obligated parties based on their refusal to innovate.
Virtually all who attended stood up to bang the drum for ethanol, including bipartisan support from 2 governors and their secretaries of agriculture.
The EPA has a choice. Protect the deep pockets of big oil and their monopolistic practices. And by God, they don't want to lose any more than 10% of the market, which they've already lost. Or they can nurture consumer choice, renewable energy growth, and a healthy rural economy.
The changes proposed in May will, if adopted, impose a radical 90% cut to production levels of next-generation biofuels like cellulosic ethanol. But there were those who testified in support of the proposed rule. They brought up concerns over reduction in gas mileage, liability for accidental misfueling, and the potentially high equipment costs that might force some gas station owners to close their doors.
Our sole objective of the part of our retailers is to sell fuels that their customers want to buy. They want to be able to sell fuels lawfully with minimal volatility and risk, especially with new fuels. The concept of build it and they will come just does not apply in our industry.
This was the only formal hearing the EPA plans to hold between now and when the comment period ends on July 27th. EPA officials are expected to deliver their final decision on the matter November 30th.
Mother Nature took no break this week from the persistent nagging of a weather system stretching from the Continental Divide to the east that served up a smorgasbord of conditions. First, there were tornadoes from Missouri to Michigan. The roof fell in at the fire station in Menominee, Illinois, damaging rescue vehicles. And in the southern Iowa county of Monroe, a tornado tore through the town of Albia. This ag-based company had significant structural damage. But the weather story that is likely only beginning is the wildfire season. Blazes were being battled in several western states late this week. As of Friday, more than 1 million acres have been blackened in the U.S., the most by this date since 2012. The entire Golden State is locked in a multi-year drought, which is greatly impacting the nation's top agriculture state. And as John Torpy discovered, much of the debate is on the water that remains underground and how that will be used for both urban and rural interests. Paul Yeager explains.
The parched earth of California's Central Valley is begging for rain. And so are the farmers who use it to grow a majority of the nation's fresh produce. Those who make a living with agriculture are enduring their 4th straight year of record drought that has been pounding California and other western states.
Given our economy and our way of life here at Merced, it's, I think to look at this lake this low is heartbreaking is probably the word for it.
Merced Irrigation District Public Relations Officer Mike Jensen spoke with Market to Market in January of 2014. At that time, he was referring to the level of Lake McClure, one of the primary sources of surface water for farmers in the district. The lake was at 22% of its average level. When we returned in June of this year, Lake McClure held a scant 12%, sending nothing but bad news downstream.
This year, for the first time, growers within Merced Irrigation District will get no water from Lake McClure. Their only water that they will have access to is groundwater. Some of our growers have private wells that they'll be able to use, and some of our growers are in areas that they can get access to MID's wells, where we're going to be pumping a minimal amount of groundwater, but it's you know, a mere fraction of what they would depend on typically from this lake.
When Market to Market spoke with almond producer Jeff Marchini 18 months ago, he was less than optimistic about yields in and around his base of operations near La Grande, California.
Almonds are a permanent crop, but there's going to be a lot of ground that's fallowed this year because of a lack of water, and there's only X going around. So you're going to see growers take whatever allocation they have or whatever fine amount of water and use it maybe to keep their permanent crops alive. And fallow those rotational crops. So there's going to be a lot of things that are just not going to get planted.
A year and a half later, Marchini was defending the amount of water he was using to keep his remaining trees alive.
Everybody, you know, throughout the valley has made changes, adjustments to try to get us through predominantly our permanent crops this year. Who we are as American farmers are, you know, we're tasked with the job of feeding the world, right? I just want to feed California at this point, and we're going to have difficulty doing that as we continue down the road if we don't acknowledge the value of the water.
Water has always been a contentious issue in the Golden State, but the fight over how And how much of the precious resource will be used in the nation's salad bowl is heating up. While 77,000 farmers continue to find new and different ways to squeeze more water out of Mother Nature's grasp, some believe that farming is the culprit for the water shortage that California's 38.5 million residents are facing. The California-based Sierra Club, a grassroots environmental organization that credits itself with helping pass the Clean Water Act, thinks farmers could do more. In a statement to Market this week, Sierra Club Sacramento president Catherine Phillips said, "A majority of farmers have not done enough to reduce their water usage during the severe drought, either by not updating to the latest irrigation technology or by continuing to plant water-intensive crops. If this drought becomes the new normal, farmers are going to have to do more. Everyone needs to do more." According to a study by the University of California, Davis, the drought has already rung up $2.7 billion in damages due to lost crops, livestock losses, and increased payments for pumping groundwater. The study goes on to show an estimated 565,000 acres of farmland will be fallowed due to the drought.
No one wants to see that kind of activity taken out of the economy. But when you look at the resilience of the California agricultural economy and the diversity that we have, that's really going to help carry us through. Now, of course, the longer this drought continues, the more inevitable some of those hard decisions will be.
Rice producers north of Sacramento are faced with those hard decisions this year. They will plant 175,000 fewer acres of rice because of the dry conditions. Some farmers found that selling their water made more money than raising a crop. Who gets to pull water from California's rivers for agricultural use is based on who has the strongest rights to do so. Farmers who own land settled before 1914 have riparian water rights, also called senior rights. These allow a property holder whose land borders a stream or river to use the water as they see fit. In an unprecedented move, senior water rights holders in the Sacramento-San Joaquin River Delta voluntarily cut water usage by 25% in hopes of avoiding harsher government-imposed restrictions further down the road. The farmers proposing the deal would either take less river water for irrigation or leave 1/4 of their crops unplanted. The water users with less secure usage rights or junior water rights are not afforded the same luxury. Earlier this spring, post-1914 water rights holders received curtailment notices to stop all pumping from drought-starved streams in the Central Valley. Those producers are now relying solely on underground wells to supply their operations.
In my opinion, water rights are an integral part of your land. I don't think there is a perfect system, but the water rights seniority system, the older they are, the more secure they are, is as good as any system I've seen.
As the battle over water continues, some see the opportunity to find common ground on what it takes to flourish in the face of this record drought.
And I view this as an opportunity to talk about, here's how I use water, and here's what I'm doing to reduce my water use, and here's what we all get as a result of how I use my water with regard to the crops. People in the state adore having local foods, and they understand more and more that it takes local farmers, and now they're understanding that it takes water. So I view this as an opportunity for a conversation to really reconnect urban and rural California. We're in this together. It will take every Californian to really do their part.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
The severe thunderstorms that raced across the grain belt this week fueled impressive rallies, with wheat leading the way. For the week, September wheat jumped 76 cents, while the nearby corn contract improved by 34 cents. More than 8 inches of rain fell in parts of central Iowa this week, lifting the August soybean contract by 43 cents. Nearby meal prices followed suit with a rally of exactly $18 per ton. In the softs, July cotton increased $3.84 per hundredweight. Over in the dairy parlor, July Class 3 milk futures lost 14 cents. The livestock sector was on the downside of the market as the August cattle contract fell $2.15. Nearby feeders declined over $6, and the July lean hog contract gave up $1. In the currency markets, the euro lost nearly 184 basis points against the U.S. dollar. Crude oil decreased again this week, down 34 cents per barrel. COMEX Gold gave back all of last week's rally and then some with a 29 per ounce loss, and the Goldman Sachs Commodity Index rose almost 4 points to settle at 435.65. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Thank you, Mike.
Exciting week to have you on the program.
It really was. A lot going on.
A lot going on, and let's talk about this wheat market. 76 cents up in Chicago. Is this going to spill over into next week?
I think so. You know, the weather that you mentioned, you know, moving through the Midwest, certainly hitting the soft red winter crop. There's all kind, you know, from Missouri up into Illinois and Indiana, the key growing areas for soft red winter, all kinds of problems going on related with this weather. Quality issues, can't get it harvested, mud issues, vomitoxin levels coming up, leading to abandonment of the crop at this stage. Just all kinds of things going on. And so I think it's breaking free of some of these ranges that it's been locked in, and now it seems to have buying coming from both commercial traders with concern of a shorter crop, some non-commercial traders who have been short this market for a long time could start to buy back into this market. So yeah, I think it's got the potential to carry into next week.
At what point do we run into the ceiling of massive global wheat supplies that we've been hearing about for so long?
You know, that's the thing. We've had this hanging over our head for years, and it's one of those things that's become old news. Now, weather conditions across the world aren't ideal, really, and however much you can read into this. So far, the best conditions might be in Russia and Ukraine, but that area's got its own issues. So, you know, when it comes to wheat, maybe we're starting to see one of these scenarios like we saw, 3-4 years ago, when world production is starting to get looked at. Some of these key growing areas are starting to be trimmed back a bit.
Advice to producers here as we work through the rest of harvest and the rest of summer?
You know, it's tough. You know, you're sitting there. You know, what's causing this rally is the fact that you're just not going to have as much production to sell. But I wouldn't be in a hurry. I'd want to give this thing some room. We saw the September Chicago contract cross its first line of resistance, I believe around 5. Numbers are terrible, you know that. Somewhere around 517. I've looked at so many numbers today, but it's crossed its first level. So I think it's got some more room to go up. It seems to be gaining some momentum. I'd probably give it a little room before I really start making some sales. Same thing in Kansas City. There's some issues there. We are hearing some reports of better yields than expected, but not much was expected of this crop. So following along on the coattails of Chicago, I think I'd give this market some room before I really load up on sales.
Let it run, maybe let it see a little correction, and then...
Yeah, I want to see it run for a few weeks. I think we've turned these markets around, and I think wheat's got some room to the upside. After being down so long, I think it's got some room to the upside.
All right, well now let's jump into the corn market. Big upside week here in the corn market. Same question with the reports coming out on Tuesday, and your favorite USDA reports are being released. Can this have the strength to overcome anything that those reports throw at us?
Realistically, yes, they should. You know, what we see on the chart patterns, what we've seen on the charts going back to last October should just eliminate any concerns that we have over reports. I mean, I really don't care what numbers come out Tuesday. I don't think it's going to be enough to offset what we see on the charts. But there is always that possibility that something could fall apart, something can blow up. I mean, it happens. It's markets. It's just the way it goes. But I think this week's activity in the December contract, we moved through the 388.25 level, moved through the 401.25 level. That's his first two resistance points. Certainly sets up a possible test in the coming weeks of 414.25, and we get beyond 414, 417, the world's open. I mean, this just opens the door to big rallies to come yet here in 2015. So, a lot of ifs in that. We've got to get through these levels. We have to continue finding the buying to push us up. What we're seeing this week, buying is again coming from both those in the cash market and those who are investing in corn. They're covering the short position. So putting itself in a very interesting position going into next week.
Looking at that 414 to 417 level, that next level of resistance, how soon could we hit it given this market's trajectory over the past week?
It kind of changed my mind. I was thinking we might see it occur late July, early August. Looks like we could easily do it next week. We could blow through that resistance next week. We got up to 404, backed off, still closed over 4 in the December corn contract. You know, if weather stays not ideal over the weekend going into next, more rains fall in the Midwest, buyers could continue because non-commercial traders still holding a short futures position. They're going to cover that at some point, even if they just take it back to zero. They're going to cover that, and that's going to provide at least some support in the market.
Should producers be looking to sell at that resistance level, or do you hold, see if we break through it, and let it run?
It depends on how much you believe charts, and most farmers aren't huge chartists, and that's just by nature. If these levels are profitable to contract. You do some, you get some on the books. Do I think long term the corn market's going higher? Yes, I do. I've thought that for a long time. But you don't want to let it go. So, if they see it, they like it, take it if it works for them. Make sure you've still got some later to sell later if this market does indeed do what its charts are showing that it should, and push higher.
Okay. All right. Well, now let's jump down into the soybean market. Rocket ship ride again on this market. And I want to start this session off with a question from one of our Twitter followers. You can follow us on Twitter at Market to Market or on Facebook, of course, at Market to Market. And this is from Chris in DeWitt. And he's curious about basis. Okay. And his question is, if there is so much old crop out there, why is basis so strong? Is it being held for a rally?
No, it's just that the beans don't exist. Similar to last year. We were told time and time again that we had X amount of ending stocks, or we're going to have X amount of ending stocks, X amount of stocks on hand. Those beans don't exist. USDA cannot get its hands around the U.S. soybean supplies. Demand has outperformed through the first 3 quarters what was expected. So I think when we get to Tuesday's quarterly stocks numbers, who knows what it's going to come in? Who cares what it comes in at? I think when all is said and done, what we're going to find, what the market's been telling us all along with the inverse in the forward curve, particularly the old crop forward curve, supplies aren't there. Now, what's really interesting is we're being told we're going to have this record crop again in 2015, huge acres, huge production. Those future spreads are moving towards an inverse as well.
And is that predominantly weather related? We're seeing these acres not getting planted, yield being hurt.
It's weather related, and it's just simply the fact we have no idea how many beans are going to be carried over, what our actual stocks are going to be going into the 2015-16 marketing year. It could be something similar to last year where we thought we had 150, 200, turns out to be 92. Right now, maybe 200, maybe 250 instead of the 300 million bushel plus.
Okay. Well, now let's get your take on the inverse of the grain markets this week was the livestock markets. We saw live cattle down $2. Does that continue here into the next week?
I think so. Again, it goes back to things that we've seen on the charts for quite some time, and that is long-term downtrend in live cattle. And on its weekly charts, too, the August has been struggling, trying to push lower. What it looks like to me is that we've got some slow building of the herd going on. We've got, we've probably reached our maximum demand for the summer. We're going to start backing off as we start making our long trek towards fall. So it would not surprise me to see the cattle market, the live cattle market, continuing to just kind of grind lower, similar to what we saw in the corn market from December through, say, early June. Just a slow grinding process.
Okay. All right. All the way down, can we give up $5, $10, $20 in this cattle market?
$20 may be a bit much, particularly just for the summer. Long term, $5, $10, yeah, certainly seems reasonable. Eventually, could the market go down $20 from where it is here? Yeah, I think it's a possibility.
Okay, it went up $20.
It went up $20.
Well, now
$20 isn't anything in the cattle market.
It's 2 days almost anymore. Now, feeder cattle market, we saw a limit down day Thursday, down $6 on the week. Could that be pretty well correlated to this rally in corn?
It is. I mean, and that's something that always seems to happen. You can watch the corn and look at the inverse in the feeder cattle. But similar to live cattle, we've got the same type of chart patterns where the long-term trend turned down last winter and short-term trend or the weekly trends are also turning down. So I think we're going to see some more pressure coming in the feeder cattle market. I think anything that happens in the corn market to continue to push it up is going to provide some pressure to the feeder cattle. I think that combined with the ongoing slide in the live cattle just aren't a lot of reasons out there right now for feeder cattle to try to turn back around.
Just a lot of continued pressure as we work through the summer.
Just continued pressure. We're going to see those days where we jump up, but they're going to be short-lived, and we're going to turn right back around and start working lower again.
And for producers out there who have been building their herd with high-priced cows, Do you need to be marketing, making some sales out there in 16 to hedge those?
I'd probably use the opportunities because, like I said, we're going to get some retracement rallies. We're going to get some bumps along the way. So I think you can use those to get some hedges on, to get some sales in place, and just protect yourself because these prices are still pretty good. I could open up a whole different argument as how good does it need to be, but I think there's going to be some opportunities to get some sales on. But longer term, I still think the markets are going down.
All right. Well, now let's talk hogs before we let you go, Darin. Down $1 on the week. Hogs have been in a slide for a while. Are they going to pull out of it anytime soon?
They've been in a slide, as you pointed out, longer than the cattle markets have, and it's been a steeper slide as well. They could look to stabilize. I don't really see any reason to get overly optimistic on the hogs. We had, I think, a hog and pig report come out this afternoon. It's supposedly bearish again. Maybe that's the reason people are going to buy because now that's out of the way. But at least it could stabilize. I don't really see it rallying too soon out of here, but it may stabilize, maybe start to slow this slide that we have been on for quite some time.
So close the week at 72. Does 70 seem like a stabilizing?
Back in the day when round numbers mattered, back before computer trading took over, I'd say, yeah, 70 would make sense. I'd have to go back and look at its long-term chart, but somewhere in the mid to upper 60s, low 70s, I think it could start to find some buying interest.
And we'll find a bottom.
Hopefully.
All right. Well, Darin Newsom, thanks for taking the time to join us this week.
Thank you, Mike.
That wraps up this edition of Market to Market. But Darin and I will continue our discussion and answer some of your questions in our Market Plus segment, only available on our website. You'll also find audio podcasts as well as streaming video of our program exclusively at the Market to Market website. Plus links to our Twitter and Facebook feeds, which have been full of weather content this week. And be sure to join us next week when we'll examine the market impact of USDA's much anticipated stocks and acreage reports. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.